Hey everyone, me Kevin here. This video is very important if you currently invest or you're thinking about investing. There's some big shifts happening in the market and I want you to be able to identify what's going on so you can prevent losing money, and that's what I'm going to teach you in this video and show you some of my tricks for. After all, remember, Warren Buffett has two famous rules. Rule number one, don't lose money. Rule number two, don't forget rule number one. The stock market is sucking today, or maybe it's a buying opportunity. It's falling hard. And when we see this much red, it feels painful. Pretty much every single human being who bought Snowflake when I said, don't buy it at these crazy prices, has now lost money. Now, that doesn't mean it's a bad investment in the long run, but with all that share dilution coming, stay away. And a lot of other things are red. So forget about Snowflake for right now. Everything is bleeding today. And there are two main reasons for this. In this video, I'm going to explain exactly what those two reasons are, and they're different from what we've seen before. See, previously this month, as just a quick recap, I mentioned that there were three factors helping drive stocks lower. Number one, a large adjustment in the tech sector, driven by Tesla and Apple's stock split euphoria wearing off, people taking profits and realizing that valuations are very high. Number two, a lack of a stimulus plan. And number three, the odds of what the stock market in general sees as a greater chance of a potential Biden victory. Now, on this last one, that's not me taking political sides. I'm just strictly looking at that from the point of view as an investor. And the reason people believe that is because Biden and Harris both want to raise the corporate tax rate from the current 21% to between 28 to 35%. So the stock market is pricing in some of that risk, which, by the way, I will link an entire breakdown of Biden versus Trump's tax plan in the link below. I've gone through that in complete detail, and I think it's very useful for you to see. But what are the big two changes now? Well, for these two changes, you're definitely going to want to make sure you've got your life insurance, which you can get in as little as 5 minutes, link below, and of course get your free stock with Webull. You deposit $100, they give you a free stock worth up to $1,600. The chart I just showed you is a Webull chart. I really enjoy their software for tracking my stocks. All right, so here's what's going on. Problem number uno. Yesterday, I made a thorough video breaking down exactly what happened at the Federal Reserve. That took, I spent a lot of time breaking down the Fed. And anytime they have changes in their moods or even their, and this sounds like weird, like what are you, a mood ring, Kevin? No. Anytime Jerome Powell changes his demeanor or he does something that's different from other times, I pay attention and I read everything they put out. Maybe that's because I went to UCLA and studied economics. But anyway, Jerome Powell is frustrated. At one point yesterday, he basically threw up his hands because a program that they spent 3 months creating failed. The Main Street Lending Program. The Main Street Lending Program was a program that we thought would come in and be able to bail out companies like the Marcus Group and Dave & Buster's. And look at what's losing today. The companies that did not get to be beneficiaries of the Main Street Lending Program, Marcus Corp and Dave & Buster's. The Federal Reserve is failing. And folks, he's frustrated. He's stuck. And when the Fed is stuck and they're like, well, there's more we can do, but realistically things they're doing are failing, that makes investors scared. And yesterday, Jerome spooked investors. He made us realize we're years away from a recovery. We're years away from a real recovery. Not the super V we've got going on right now in some stocks. Anyway, we're years away from inflation. We're years away from going back to normal. And yeah, we need another stimulus package, but honestly, Jerome Powell says we've already priced in a stimulus package because the market is expecting a stimulus package. Most private forecasters, his words, are expecting it. And many of the board members at the Fed are expecting another stimulus package. Without that package, oh yeah, we're going to have lasting scars, his words, and permanent damage, his words, and we're still years away. This comes at the same time as Yelp reported that 60% of businesses who temporarily closed during the pandemic have permanently shut down. Now, the good news in all this bad news is the Fed doesn't see interest rates going up until at least 2024. But honestly, if you watch my Fed video yesterday, which I really encourage you do, they don't even give us a path for rates to go up after that. And Jerome bluntly said that we won't raise rates all of a sudden. It's not like once we hit 2%, whoops, we're going to raise rates. No, they're not going to touch rates until the recovery is, quote, well underway, which is a phrase he's used before. But then he went even further because he was so frustrated, and he put emphasis on this the way I'm about to do it. He said, we won't raise rates until we are far along. That's his emphasis on far along. Yeah. So this is in one sense good because it means lower borrowing costs, but it's a double-edged sword because it means, ooh, the economy's not on the solidest foundations as much as we thought. I've been saying for probably about 4 months now that I think this is going to be the decade of frugality. This isn't a 1 or 2 year thing. This is a massive societal shift in the way we spend money and the way our economy works. But there is a very severe risk during times of low rates: over-leveraging. That's why over the past month, and I'm going to talk about the big second problem that's going on in just a moment as well, and how to identify some more trends regarding that. So stay tuned. The second thing here is pretty big as well. But over the past month, I just quickly want to say, I've been on debt payoff mode. I talk to all of my course members about this daily during our live streams when the market is open. And I've been saying it on this channel. I've been on debt payoff mode. This morning, I completely paid off all of my Robinhood margin, which I've kind of been working that down for a while, as well as this morning, I paid off all of my credit line debt. And one of the reasons I've been doing that is just so that I have more debt available if I want it. If the market falls, I'm not in crazy amounts of margin or credit line debt. But if the market does fall, I also have the opportunity to pull that money out and go shopping again. See, for example, here's my my Robinhood, and I'm really excited. Margin available is pretty much all of it that's available. Like, I have zero margin outstanding, which is super exciting to me. I'm really happy about that. Now, I do have some margin over at M1 Finance, but I'm also working on paying that down, and I've been saying that for about 6 weeks to maybe even a couple months now, mostly because, well, valuations are kind of high, and it does make sense to, eliminate risk. This means I have zero credit card debt and zero credit line debt and zero business line of credit debt, which, if y'all remember watching me back in March and April, that's literally the opposite of what I told you. In March and April, I'm like, take out all the debt you could get your hands on and go shopping now. Now's the time to shop. I'm doing the opposite now. Okay, but here's the big second massive issue right now. And I want to teach you how to spot these trends that you might be investing in, or big problems for companies that you might be investing in. Because yeah, this is a serious issue. We are facing a potential tidal wave of bankruptcies, and these are going to reverberate throughout the country, and they're threatening to steal our money. The New York Times believes that this year will easily set a record for, quote, mega bankruptcies by companies with over $1 billion in debt. They're saying things like, the really hurting companies have gone too far to be saved. And the New York Times further says that many businesses are just barely trying to get through another earnings season, basically, before the hammer will drop. In my opinion, this is because the executives are trying to show their investors, we tried everything we could, but we couldn't make it. But they're giving us red flags in the meantime. I'm going to teach you how to see these red flags. Some of them you might be like, oh, come on, the red flags are obvious. No, I'm going to watch some of these tricks, okay? They're seriously good tricks. I mean, some of these companies, like, we already knew were dying. Like, we knew JCPenney. Come on. Like, seriously, like, that wasn't a surprise, right? Like, when Sears went, was that a surprise? No. But some of these other ones, the paper store, Brooks Brothers, okay, maybe we saw that coming too. But Pier 1, Neiman Marcus, Roots, True Religion, Jose Banks, like, some of these, like, I certainly didn't think before this pandemic that those companies were going to go. But folks, this is just the beginning. The Financial Times ran a story saying U.S. equity markets might be breaching record highs, but the state of corporate distress in this country has never been worse. Large corporate bankruptcy filings are now running at a record pace and are set to surpass levels reached during the global financial crisis. Yeah. The Financial Times warns that we are, quote, in the first innings of this bankruptcy cycle. And folks, many of these companies, well, the writing has been on the wall. In fact, let me teach you a prime example for how to determine if a company that you're investing in is starting to gear up to go towards bankruptcy. And remember Warren Buffett's rule, don't lose money. Now, that doesn't mean that every single stock investment you make is going to be profitable. I mean, even Warren Buffett sold out a Delta at like $23 after having bought it for $43. So he even loses money too, right? But your rule, and rules sometimes fail, right? But your goal is not to lose money. So you want to have all of the competitive advantage that you possibly can to determine if a company is going bankrupt. And so what I want to do is I want to show you exactly some things that I identify coming bankruptcy with, beyond just like, oh, well, duh, of course, when you say that company's name, of course I thought they were going to go bankrupt. Right, fine. It's easy to say that, but it's hard to identify exactly why. But I'm gonna show you some ways to kind of give you a cheat sheet on this. So that way, if you're investing in some companies, some of these recovery stocks, Delta, Carnival, okay, watch. But first, on June 9th, I made a large investment into Dave & Buster's as COVID cases were declining and the pandemic basically seemed over. I mean, like, we went to the beach and like everybody was going out again. Like everything seemed normal again. Like the shutdowns were lifting, everything seemed normal again. And it's like, okay, cool, where's leftover value? Like literally recovery stocks were booming and we were looking around going, okay, well, what's left behind? Like what else hasn't caught up yet and where can we maybe invest? So I invested into Dave & Buster's. But 17 days later, 17 days after I made that investment, and I even edited the title of that Dave & Buster's video saying, don't buy it. And I put a little note that I pinned at the top saying, bankruptcy risk, don't buy, in the pinned section of the comments. So I left the video up just to show, like, look, I'm not like a prophet, but I can identify changes and I'm gonna react to those changes. Some people ask me too in the comments, they're like, Kevin, how come we're on V11 now on the 1337 index? Like, why can't you just leave it as one thing? Well, because changes happen in the marketplace and you have to adapt to these changes. That's, to me, that's what being an investor is. But anyway, listen to what I said just 17 days after I bought Dave & Buster's. And I want you to, like, so this is really important to know. Because you can identify this in your companies too. Okay, here we go. Listen to this. Play. So every day that goes by on these speculative companies, the bankruptcy risk goes up. In fact, take this for example. Dave & Buster's, their last quarterly report in 2019 mentioned bankruptcy 0 times. That's good, right? 0 mention of bankruptcy. Why would there be a mention of bankruptcy? The first quarterly report, because I actually read these things in 2020, mentioned bankruptcy 3 times. The second quarterly report in 2020 mentioned bankruptcy 34 times. Yeah, like, oops, right? That's a huge shift. That's just one example of how to determine, okay, well, you know, things are going into a little bit of maybe the wrong direction here. But it's not only that. See, I recommended don't keep buying into Dave & Buster's, but for those of us who held on, you know, some of us bought at 15, 16, 17, 18, that's okay, we had an opportunity to sell out. In fact, last week, when the Dave & Buster's earnings report came out, I said, okay, I'm officially dumping all of my Dave & Buster's stock. And we were able to sell at about $18.50, $18.25. So some of us who bought it at 19 maybe took a little bit of a haircut, but many of us didn't have to sell like super low. It's not like we had to sell when it was way lower, right? But listen to what I said in the warning about a week ago, and this isn't to pat myself on the back, it's because I want you to identify what these trends are. So we saw that bankruptcy, you know, mention went up dramatically, which we'll talk about Carnival and Delta in just a moment. But watch this. This was just a week ago, and watch what I was paying attention to just a week ago on Dave & Buster's here. Here we go. They sounded so defeated. Right after this, or the Dave & Buster's one, I listened to the Peloton one, and these people were like chipper and excited and like, we love this company. We're like, don't call us a COVID company. We're not a COVID company. We're here to stay. Like that was Peloton, okay? Dave & Buster's was like, yeah, we just don't know. Like I could just imagine their boardroom meeting. How many months do we got left? It's not good. It's not good. So anyway,
here's one.
This was a big one, okay? They said, this is so bad for Dave & Buster's. They said, quote, society is now used to eating at home and watching TV at home. We have no idea when they're gonna come back. Oops, that's not good. So for Nicola, I said for Nicola, I'm out. Like Shark Tank, I'm out. Okay, now I'm gonna fast forward about a minute. So what we learned in that part there is, their enthusiasm, like the executives, sound like crap. They sound dead. They sound like zombies. You can listen to the earnings calls. Just type into Google for whatever company you're interested in. Dave & Buster's investor relations, Delta investor relations. Listen to them and their demeanor from prior earnings calls to the current earnings call, and you will know, because the executives know if the company's gonna go bankrupt. and you can read between the lines. But watch this, okay? This was another good example. And then we're gonna get into Delta, Carnival, and some other takeaways here. But this was another good example where I'm like, this is bad, okay? It's stupid ideas. Listen to this and tell me what you think about this as I present this here. Just think about it. This is the part that made me like fall out of my chair, okay? After them talking about how society is used to eating at home and watching stuff at home, then they were asked by an analyst, okay, well, what are you gonna do about it? And here's what they said. Well, we're gonna start investing into cloud computing games, and we're gonna launch a radio station, for the stores. We're gonna change the vibe of the stores. We're gonna, have like DJs, and maybe we'll do like giveaways and partnerships and stuff. And I'm thinking to myself, y'all dead. Like, those are terrible ideas. That's not what Dave & Buster's is. I don't go to Dave & Buster's for a DJ. You go. Anyway, in that video, I said, that's it. Like, that is so stupid. I'm out. And I said, get out. And look, we already knew that Dave & Buster's was a bankruptcy risk because of that earnings filing showing all these increasing mentions. We already knew that we already knew that Chuck E. Cheese went bankrupt. There was also another amusement park in April that went bankrupt that did kind of like this game style thing. I don't remember what the name was, something with an A. But anyway, like there were some risk factors here. Couple those things with not seeing a Main Street lending program loan, no mention of it. We know the program's been failing. That's not good. Okay, so no lifeline for Dave & Buster's. And couple that with horrible executive enthusiasm and idiotic ideas, I'm like, no way. And you heard me say it. This company is dead. I'm out. Well, guess what happened today? The company today said, unless they get a bunch more debt, which is also bad for an investor, they're filing bankruptcy. Like they straight up said it today. They're doing layoffs. Bankruptcy planning is now in full motion, and they need to take on more debt to survive. No surprise. The writing was on the wall. And again, like I know there are always the comments like, oh, well, you should have seen that coming. It's the same thing as Nikola. Look, when Nikola was like $85, I made a video and I said, like there's gonna be huge share dilution. This is bad. This thing's gonna plummet. And I got so much hate in the comments, like, oh, what are you talking about? Like, this is the next Tesla or whatever. I'm like, fine, just be careful. So, just gotta look at the signs and make your own decision is what I always recommend. So, here are the things to watch for. Number one, a company mentioning bankruptcy a lot. And I'm gonna talk about Carnival and Delta in just a sec. A company mentioning bankruptcy a lot. Similar competitors going bankrupt. The industry being on a downtrend. The executives said themselves, people are more used to eating at home now or being entertained at home. Number four, the executives lose hope or have no plan. Or bailout lifelines that you thought were gonna be able to come, like Main Street lending, don't end up coming through. I mean, we got 5 straight up things telling us, those are things that could be bankruptcy warnings, and those say, don't invest. See, like ever since that earnings call, I told Lauren this, I told my course members on the live streams in the mornings, I mentioned it on the YouTube channel somewhere as well. I said, look, if these executives wanted to get real, they would be going, let's get a tent and do curbside pickup. We're introducing new food lines that are easier to take for to-go. We're gonna have all the machines set up outside with hand sanitizers, and we're gonna do parking lot games. We'll do the hacky sack, who cares, whatever, like the cornhole. Like there's so many million things you could do. You could put all the electronics outside, or we'll open the doors and we'll have HEPA filters inside. They didn't say any of that. Like, that's what I'd be thinking if it was my business. What'd they do? Nothing. Well, obviously, I recommended also 2 weeks ago reducing my stocks in recovery stocks like Carnival, Delta, Cheesecake, Dave & Buster's, and these other companies because just in general, the trend isn't so great for recovery stocks right now. Everybody's just waiting and hoping and praying for that vaccine, but there's still a lot of pain out there. Okay, so this is what's been going on, but let's take a quick look at Carnival Cruise Lines. Carnival Cruise Lines, I made a video like in April, which is gonna go bankrupt first, Carnival or Delta? Yeah, okay. And out of all the airlines and the cruise lines, these two were my favorite. But I sold out of the vast majority of the heavy recovery stocks that I had in May to buy tech, which was nice because there was a nice run up between May and August, and then I finished selling off my my recovery holdings just about 2 to 3 weeks ago. But here's the thing. In the last quarterly report for Carnival Cruise Lines from July 10th, they mentioned bankruptcy 67 times. Their April report mentioned bankruptcy 0 times. So literally from April 0 mentions to July 10th, 67 mentions. Now, Carnival is also selling 18 cruise ships because of financial trouble, and they're looking for more debt. And again, like some of this should be like a duh, you know, we're in a pandemic, you can't go cruise lining, but you still look at the stock and you're like, oh, it's so juicy. Like, I'll go get some of that value. Delta Airlines, folks, okay? In April, they mentioned bankruptcy 14 times. That's not so much. Fine, that was April. In their last report, it was June or July, Delta mentioned bankruptcy 77 times. And they mentioned insolvency 38 times. Seriously, folks, this video is a warning for all of us. If you're investing in recovery stocks, I'm not saying sell, I'm not gonna tell you what to do, but do look for those 5 red flags we talked about in this video. Take 30 minutes, look at the earnings reports. Are they mentioning insolvency? Are they mentioning debt? Are they like taking on more debt? Are they mentioning bankruptcy in general? Are they saying stupid things on their earnings call? Is their enthusiasm like negative? Like, are they like soul-sucking vampires? The amount of debt these companies have to take on is atrocious, and the world is not going to go back to normal, at least not for the next 1 to 2, maybe even 3 years or more. And that's why I call this the decade of frugality. Keep your debt low right now. In fact, I just want to prove it to you that I am literally doing that. Because you might not believe it otherwise. So I bought an Apple computer for like an insane amount of money, like one of those Mac Pros for like $13,800, and I returned it. Like I broke my normal frugality, and I'm like, that's it, we're investing in another computer. And I'm like, that's okay, it's okay. Yeah, no. Look at this. Just to prove it to you, I returned that computer. Not because I need the money, but because I want the money. So that way, if more opportunities come up in stocks, I have it. And look, here's my Apple Card statement. Look at that. Apple Store refund yesterday, $8,300. Apple Store refund, there it is, $5,799. And then the cool thing too is all the way at the bottom there, you see that ladder thing? See, that's my life insurance that I Apple Pay with. You should get that as well. Remember, you could sign up in as little as 5 minutes. But yeah, seriously, I even sold out, or I canceled some reservations that I had, some down payments on cars that are coming up. Not because I really want the cars, but because I want to be a part of the growth for that, to make YouTube videos on it, and to see if I want to invest in that company. You know, could it be, think like Rivian, think Nikola, obviously Nikola, forget about Nikola, but think about some of these newer companies, or even the Lucid Air, right? Like some of these companies, they'll take your deposits, and then you get into events or things like that earlier. Well, I canceled all those. So I'm like, just give me my money. I don't really want to buy these cars anyway. I love my Tesla. Just give me my money. So that way I can buy stocks if they continue to dip down. In the meantime, I'm just going to pay off margin, so I'm more prepared. Trust me, this isn't out of fear. It's out of realism for me. Remember, in March and April, y'all know I went on a massive buying spree in stocks, and that continued through May and June and July. Well, now, in the last couple months, I've been more on debt payoff mode. I'm doing the opposite. And that's because I feel our fundamentals just aren't strong enough right now, and I encourage you to be careful and frugal right now. Thank you so much for watching. If you like this content, please consider sharing it. I know these stock videos don't always get the most views. Check the stock playlist. I have a whole stock playlist just for stock videos and Federal Reserve videos. So that way, if you don't like some of the other content that might get suggested to you, you might appreciate just going to those playlists. Thank you so much, and we'll see you next time.